So there's a lot of fear out there still, and of course for good reason. The market's really rolled over, and so no one knows where it's going to go, but we're going to explore where we think it might. So stick with me as we discuss the support levels of the S&P 500. My name is Brian Cannon, and welcome to Markets in 5. All right, let's jump into the S&P 500. So clearly we're in a downtrend. So we've got lower highs and lower lows and heading the wrong direction. So this channel trend here has definitely been respected by the market. So we've got kind of resistance, broke through it, came down, support, broke through, resistance, and here we are again. So we're knocking at the door. So the question is, will we fall back below it, or will we jump above it, get what we call a dead cat bounce or a bear market bounce? So if we do and we get above it, then I would anticipate us having a very, very hard time getting back above this upper channel. So that's something we're watching closely. Obviously, if you break above this upper channel, it's game back on for the most part. I mean, there's other things we're looking at, but right now the S&P is trading below all of its moving averages, and that's not good. So again, anything trading below a 200-day moving average usually is sick, meaning there's some problems with it. So any investments that we pick up, even down here, are going to be trading above their 200-day moving average period. So this is an interesting chart. Let me get out of the way here. So this is a measure of market breadth or momentum, right? So how many companies are participating in the market, right? So we talk about moving averages all the time. So we've got a 50-day moving average and 200-day moving average. And again, I just mentioned anything trading below its 200-day average is sick, and you don't want necessarily to own it. You'd rather have companies and select from companies that are trading above it. Well, when you've got 76% of the companies trading below their 50-day moving average, that shrinks the pool of companies that you would want to invest in. And then you've got of the 500 companies in the S&P, 69% of them are trading below their 200-day moving averages. So again, it's just not a time to do a lot of stock picking. I'm not saying you can't do it and you can't be successful at it. It's just the pool of companies that you're trying to select from is shrunken dramatically, right? So it just makes it harder, and so we've got to just pay attention to that. Now, when we see that swing to the upside and start to break out, then that means more and more companies are participating, and that means that we would want to begin picking some good stocks that we feel like are going to be around in 10 or 15 years that are trading at huge discounts. All right, so the S&P 500, if we look at it on a weekly basis, it takes a lot of the chatter out. And so there are certain things that you can kind of gain by taking a kind of a bird's eye view. And here we are. You can see clearly the 200-day moving average on the 50-day weekly, on the weekly S&P 500 is respected that 200-day moving average. So it came down and supported it in 08 and then broke through it. We had the crash in 08, 09, came back up, couldn't get through it, broke it, eventually broke it to the upside, and what was resistance now becomes support. So that's in 2011, and then it fell back down in 2016, fell back down in 2018, and here we are now. So if we cannot hold the current levels that we're at on the S&P 500, I fully expect the S&P to fall back down to that 200-day moving average, and I believe that's where buyers will come back in and start redeploying cash, and we'll be right alongside with them. So that would be a very, very natural area for the market to find support around this area. So but that's about 11.5% away from where we're at now. So it's not going to come without some pain, and I'm not saying we're going to get there, but I'm just saying that's a natural level of support that if we do get there, it's time to start putting that cash back to work. So this is an interesting chart. This is kind of measures the level of bears in the market, and we're at the highest levels of bears all the way back since the lows of 2008, 2009 crash. So I find that interesting. And these types of levels that we're at um, generally mark the bottom of a market pull down, and not the middle. So I mean, I'm not so sure that we won't break this level and head back up. I'm not sure, but I'm just saying that we've got a level of reading of bearishness that is in line with the bottom of 2008, 2009. So again, that's kind of a good sign as far as folks. Once the fear levels get to an extreme, usually it's time to start buying. So again, we're watching these levels closely. But again, if we hit that 200-day moving average we talked about in the last chart, it would coincide with this upper channel trend as well. So that's a very, very natural place for the market to find support. So again, that's the level we're looking at. If we get there, we're buying. So as you can see, with fewer companies participating in any sort of positive momentum for the market, and the fact that there's a lot of fear, the sign of fear could be the mark of a bottom. But we're not sure at this point yet. But obviously, we've got some support levels that could be well below where we're at now. We just don't know. But the key is just to continue to have an allocation that's appropriate for you. So if we can be of support, or if you have any questions, certainly give me a shout. And look forward to seeing you on the next Markets in 5.